In this weekly stock update, I'm going to go over HIM's $350 million loan. Initially, investors sold off the stock, but I'm here to explain why it could be making investors a lot of money. I'm also going to go over Nvidia's earnings. They're the top dog of the stock market, and guess what? They've released top dog earnings. So I'm going to go over what it means for the stock market as a whole, and then also go over what happened last week and what you can expect next week. I'm also going to go over my $100,000 challenge, week 51. Let's get into it. All right, everyone, this is my weekly stock update. So let's get into the topics of the day. HIM's $350 million loan, Nvidia earnings, and my $100,000 challenge. Please give a like and subscribe. I really appreciate it. It really helps. I have a full-time job, 2 kids, a lot going on. So it takes a lot of extra for me to go through all this, but I love to do it. Is HIM's a buy after their $350 million loan? I'm going to go over it. Right now, the stock is at $23.75. This is of May 22nd. That was Friday, and went down 1%. So not looking too great. The Novo deal, since the Novo deal, it's up a little bit. But since the peak of the Novo deal, of all the excitement, it's actually down 10%. It's still down 10% since everyone got excited for the Novo deal, right? As you can see, it's been on this little roller coaster. So that's just something to keep in mind. HIM's did this $300 million convertible debt offering. Convertible senior notes due 2032. So let's do this in plain English to make this as easy as possible, because this helped me a lot too. Think of the deal that HIM's is taking as a special kind of loan from institutional investors. HIM's borrowed $350 with the option of $52 more from investors. HIM's is going to pay 0% interest on this loan. They do not have to make regular cash payments to the lenders. The convertible twist: instead of just getting their money back in cash when the loan matures in 2032, the lenders have the option to swap their debt for HIM's stock. The catch for lenders: they can only swap the debt for stock if the HIM share price rises above $29.53. If the stock stays below that, they're typically just going to get their money back. That's kind of bullish, because if the investor's like, yeah, we'll agree, and we don't even want any stock unless it gets above that. I mean, they think it's going to get above that, right? I mean, 2032 is 6 years, but there's more to it. So the deal size is $350 million, conversion price $29.53. The premium from when I did this was 32%. So, from the price of what it was at $22.30, interest rate 0%. And the maturity date is June 1st, 2032. So why did HIM's do this? Well, they wanted expansion to pay for the acquisition of eucalyptus and also technology to invest heavily into their AI capabilities and fulfillment infrastructures. They have, this is, I should have put a star on this. Protection against dilution, right? HIM's used some of the borrowed money to buy capped calls. This is a complex financial tool, but you can think of it as dilution insurance for existing shareholders. The problem: if the stock price skyrockets right past that $29 and the lenders convert their notes into shares, it's now going to create a lot of new shares, which dilutes the value of your shares. So the fix: the cap calls offset this dilution. They effectively raise the price at which dilution would actually hurt shareholders up to $50 per share, almost double the current price, which actually it is. I don't know why I would say almost if it was based on 22. $50 is definitely more than double $22. That's more than $23.79, I think it was, right? So right now, let's go over exactly what this means, right? What this means for you as an investor. So the stock price initially fell a little bit after the announcement, which is normal because investors fear the dilution. But HIM's got a massive pile of cash to grow the business, and if they use the money wisely to acquire eucalyptus and improve their tech, the deal could be very positive for the company's future. Because this is a 0% interest rate, the short-term impact on their income statement is surprisingly small. It will not burden the company with heavy recurring interest expenses. However, it will affect the income statement over time through 3 main channels: issuance costs, diluted earnings per share, and future acquisition metrics. So the interest expense, it's basically close to zero, because the reality is usually when a company borrows $350 million, there's a large interest expense line item that appears because they are paying interest. Well, because this features a 0% coupon rate, HIMS will not record any regular cash interest expenses. That's good. The accounting nuance under the modern the GAAP rules, companies no longer have to split the convertible bonds to fake an interest expense, meaning the recorded interest expense will remain zero, basically. Non-operating expenses, a small upfront hit. HIMS will incur $11.5 million in transaction fees to pull this deal off. And while the bulk of this is handled on the balance sheet, a small portion allocated to the equity component of the deal or general administrative fees may show up as other non-operating expenses. The big one is diluted earnings per share, right? Right now, the basic earnings per share is going to be unchanged because those shares do not exist. They have not converted them yet. But the diluted EPS, this metric calculates what would happen if all options and notes were converted to stock. So under the if converted accounting method, HIMS must include the potential new shares in its diluted share count. So when you see the diluted EPS, it's going to be a lot worse than the basic EPS. The silver lining becomes because HIMS purchase cap calls, the dilutive pressure becomes neutralized until it crosses $50. And then the entire point of raising the capital is to deploy it. Top line growth. Once the acquisition of the Australian eucalyptus closes, its revenue will be added directly onto their revenue line, which is going to be huge. Operating margin impact. HIMS plans to spend heavily on AI scaling and physical fulfillment tech. This will increase their R&D and SG&A expense items, impacting operating income for the near term. That's fine. So the bottom line, in the upcoming quarters, do not look for any massive interest expense. Instead, look for higher overall operating costs because of eucalyptus and expanding their AI infrastructure paired with a larger diluted share count, right? So let's go over the cap calls and what that means, right? We saw that the banks, the investors cannot convert their shares until it's $29. What about the cap calls, the $50, right? It's protecting the diluted, the current shareholders. So what does that mean? So when the cap call price, in this case $50, is set much higher than the stock price, it usually signals three main things about the company's outlook: management confidence and the cost of the deal. So management expects massive growth. HIMS management is explicitly stating that they believe the stock has potential to more than double. The logic: if management thought that the stock would top out at 30, they would not waste money buying insurance up to 50. This is an insurance. HIMS bought an insurance for their shareholders up to $50. That's what they did. They chose a high cap because they want to protect shareholders from dilution during a major long-term growth surge. That's good. Oops. A higher true dilution threshold. The baseline: without the cap call, existing shareholders will start facing dilution the moment it crosses $29.53, which we all know it's going to happen here soon. Eventually, the stock runs up pretty high quickly, and then it can drop really quickly too. The reality with the cap: because the cap's set at 50, the cap call effectively neutralizes the dilution. As an investor, you don't have to worry about your shares being watered down by the deal until the stock experiences a massive rally past that $50 mark, which at that point you have already made a lot of profits, right? So even though, yes, it will be watered down, the market share, everything your shares will be worth that much more. So even when they do it, the shares won't be watered down nearly as much. And then the company paid a higher upfront premium. The trade-off is, you don't get a higher insurance for free. So, they set the cap all the way to 50. So they did pay a higher upfront cost for that, but they were willing to trade that chunk of cash to better protect their shareholders for tomorrow, which that is very nice of you guys. Bullish institutional sentiment. Now the counterparty, the investment banks selling these cap calls to HIMS, are sophisticated mathematical models. You have to understand that someone had to sell them this insurance. The banks agreed to the price structure because their data shows a realistic, calculable probability that HIMS can reach these heights, allowing them to price and hedge the risk effectively. So there you go. The summary: a cap call is set significantly above the stock price, or a cap call that is set significantly above the stock price is a strongly bullish structural design. It shows management team confidence in their 5 to 10 year growth runway and a willing to pay a premium to protect their current investors from early dilution. So HIMS is protecting their investors. Now, if you were to buy today, it's 23% up when it goes to the conversion price, when those investors can start converting those notes and debt into shares. But it's 109% to that 50-15, right? The capped call. So you could be making 100% on a stock before any of that dilution really starts to take effect and water down shares. So that's a good thing, right? I mean, you'd be already making massive profits. Do I think HIMS is going to get to $50? Absolutely. I mean, look what it was doing in 2025. It got over there. Now, of course, it went down, and but it's hit 70. It's gonna go over 50 eventually. I think in the next couple of years, for sure. But will it go back under 50, and then go back to and then go to 100, and then go to 70, and then go to 150? The stock moves so wild that you just don't really know. But the point is, I do believe HIMS is a buy with all of that insurance that they're buying, that their management confidence. I do believe in it. So let's go over Nvidia earnings, right? They're the top dog of the stock market. A+. Revenue went up 85%. This company makes so much money, and their revenue went up 85%. That's just crazy. The cost of revenue only went up 18%, so the gross profit went up 129%. It's crazy to see that a company that is, because I talk about how when you are such a big company, when your market cap is so big and you're already doing so much business, your growth rates are hard to continue to grow. Like you look at a HIMS where a couple years ago, you're growing at 100% revenue, right? Well, then once you start getting into the billions of revenue, and it's harder to just grow at that pace for a very long time. But some stocks prove otherwise. Their total operating expenses went up 52%. Operating income went up 147%. Their total other income went up 5,900%. It wasn't like a huge, but it went $16 billion. It went from 272 million to, that's just crazy. And then the net income went up 210%, and the diluted per share 214%. I don't even know if you can see it. This is amazing, right? Look at this stuff. This is good stuff from Nvidia right here. It's amazing. It's amazing what they do at their size, right? Also, the company had $38.5 billion remaining under its share repurchase authorization. On May 18th, the board of directors approved an additional $80 billion to the company's share repurchase authorization without expiration. They also increased their quarterly dividend from 1% to 1 cent to 25 cents per share. Amazing. Their PE is only 24. Right? It went down 5% too. It went down 5%. The week of their earnings, it went down 5%. Their PE is 24, 25. It's insane. Look at all these analysts, right? Strong buy. This is all like the week of them, and this is all on a Friday or a Thursday. Strong buy, right? Everyone's buy Nvidia. But the market sold. Really weird, right? So let's go over the stock market. What's been going on? The S&P 500 went well, right? The S&P 500 went up 18% in 53 days. It's been on a roll. NASDAQ is up 27% in 53 days. And the Dow Jones is up 11% in 53 days. The Dow Jones has finally gotten new all-time high. Finally reached it after this whole time. It had that big drop, that big crash with everyone else, but then, it wasn't able to pop with our, and as you can see, the gains is not as big as the other ones, right? Here's a heat map, Nvidia. Look at that. It's out of all these big stocks, Nvidia went down that's just weird, right? I think investors, Wall Street, everyone's just been they got exhausted from Nvidia. Everyone feels like all the big gains are already set in, right? Now they want AMD. Now they want Intel. Now they want a Cisco. They want, these other, Dell went up 22%, right? You have all of these stocks that, went up a lot more and may not be growing as fast as Nvidia, but people are just, they've grown exhausted from the stock. So they're going on to other stocks. You have IBM up 16%. You have, is that Palo Alto Networks, right? Yeah, that's 9%. You have Walmart down 10%. That was the other big one that I saw that was, these other ones, not so much. I mean, you have Deere, but yeah, it's crazy to see how Nvidia is going down while the other chips are going up. The AAII Sentiment Investor Survey, the bulls went down. It went from 39 to 31, and the bears went up, went from 36 to 43. Neutral kind of stayed roughly the same, 24% range. So the bulls went away, but, let's see, how would you describe the earnings guidance given by the companies during the first quarter? And people are saying it's better than expected, which is interesting. People got less bullish, but the earnings guidance by companies was better than expected. Seems a little contradicting, right? But whatever. Let's check this out. The Fear and Greed Index. This is always fun to look at because right now we're in a greed territory. May 22nd, greed territory. Okay? Let's just look at 2 months ago. Fearful. Right? That the market is emotional. The market is as emotional as... I don't want to say something. But it's very emotional. NASDAQ is up 19% since March 13th. Everyone was fearful. Maybe you should get greedy. Now, did the market go down more since then? Yeah, it did. For a little bit. But in the end, you made money. So you just got to be prepared for that. Last week's news. What happened last week? Well, the Fed, they signal a higher for longer stance as inflation is lingering. The officials remain deeply concerned about stubborn inflation data. Several policymakers their willingness to tighten monetary policy further if inflationary risks materialize, catching investors off guard. Look at the inflation rate, right? The inflation rate, when you look at it, since 2020, since we've come down from this big drop of 2022, I think everyone remembers the inflation just skyrocketing. The end of 2021, all into 2022, it started to come down. We haven't had those levels. It's the highest level since that. We were on our way back down, trying to get back to these levels, right? To this level right here in the twos. And now the inflation rate, it's at 3.8, right? So that's not good to see because then that means the Fed's going to keep the rate for higher for longer. The tech sector volatility intensifies as post-earnings pivot. So large cap tech companies experienced a rocky week of trading as investors aggressively shifted capital between hardware providers and software giants. So as you can see, Nvidia, they're like one of the top dogs, but they're the ones that sold off the most, while AMD, the lower cap, the smaller, it's the medium, right? Mid-range cap is it's still probably large cap, but it's not like one of the top dogs. And you could tell the rotation, right? Salesforce and ServiceNow, they got into it. TSM even did a little bit, but Nvidia just went down, which is just, interesting with those earnings that they had. Energy commodities surge on Middle East supply chain fears. So crude oil and natural gas prices marched higher this week following renewed geopolitical tensions and transit disruptions in key maritime shipping lanes. So that was for what happened last week. What happened, or what should we be looking for next week? The upcoming release of the core PCE inflation data. Now, The Bureau of Economic Analysis is scheduled to release the PCE price index, next Friday. As the Fed's preferred inflation metric, this data point carries immense weight. A reading that lands cooler than expected could revive hopes that, maybe they could lower the interest rate and it could spark a rally. Conversely, if there's an upside surprise, it will likely lock in the higher for longer narrative, pushing treasury yields upward and straining equity valuations. And when you look at it, the core PCE, it skyrocketed during, 2022, 2021, 2022. We know that. But now it's skyrocketing again. And it hasn't been at this level since 1990, if we're excluding 2021, 2022. We have not been at this level since 1990, right? So this is a cause for concern. This is not good. Q1 GDP revisions and the strength of the U.S. consumer. So the second reading of the first quarter GDP hits the wires next week, accompanied by fresh retail sales revisions. Investors are hyper-focused on whether economic growth is cooling off too rapidly under the weight of restricted interest rates and inflation, or if the consumer spending remains strong enough to stave off the economic contraction. Let's be honest. The consumer that can spend enough is the rich. I know the people that are middle class and everything. I'm middle class. Like, we're not doing well. We're not doing this where, I can still just be spending and spending and spending because I just have the money. No, I also have 2 kids and crazy little situation, but it's just like, don't have a lot of money to spend after you take care of all your needs, right? And then a just right number is vital, maintaining economic soft landing expectation. We've been talking about the soft landing for way too long. At this point, we've landed and we're moving forward. Major retail earnings are going to reveal economic friction points. A final wave of heavy-hitting retail earnings reports is happening. So depending on the management commentary for consumer fatigue, trading down behavior, and margin compression, right? A weak forward guidance could trigger a defensive shift in the market. So we'll see exactly what they say. So let's go over some of these earnings. We have Dick's Sporting Goods, Bath & Body Works. We have Salesforce, Snowflake, Hormel Foods, Burlington, Best Buy, Dell, Costco, Gap. All of these companies, AutoZone, except for Salesforce and Snowflake, a lot of these are going to be they're retail. And they're going to be able to give us a little bit of a look into what's going on behind, it's not like we have Walmart and those other ones that are really the big hitters. So, we also have HP. So we do have some stocks in there, but it's just, I personally think that the consumers hurt right now. That's just my opinion. So my $100,000 stock market challenge, I'm at week 51. I am almost 1 year into my $100,000 stock market challenge. Now, if you know anything about it, I put $7,354. That's what I started off with. I already owned stocks. I had already owned HIMS. I had already owned some Celsius and TQQQ. So I already owned these stocks when I started the challenge. HIMS was at 50 or 52 when I started the challenge. So when I started the challenge, and HIMS was my biggest position, I knew that it was going to be a rough first year to 2 years for my portfolio. I knew it. I said, look, I believe in HIMS. I believe in the price that I have it, the cost basis, but it's going to go through a lot of volatility. And I don't think my stock market challenge is going to do great for the first year or two, but I think over the long term, it's going to do great. So I started off with $7,354 in the account. I already held stocks. And I said, look, I'm going to start a challenge and I'm going. So I put $50 every week and I just keep investing that money. So right now I'm at $9,226. I was up 1% last week. I'm down, or my goal, right, was to be at $11,581. So I'm down 20% from that, right? I'm 20% away from my goal. But since June 2nd, I'm up 25%. If we take away my $50 deposits, I'm down 14.5%. That shows how vital making deposits, just little deposits, matters. That helped the account continue to grow, even though if I had not done anything, I had just left, it would be down that much more. So making small deposits every week matters tremendously. Because I have bought some stocks, like I bought some Salesforce and stuff like that has gone down. I made some mistakes. I did buy some Fubo, and that hurt my portfolio. But nonetheless, I have bought other stocks that I believe are closer to the bottom, and I'm going through some short-term pain. But I think at the end of the day, this portfolio is going to be, not the end of the day, let's say at the end of the year, at the end of a few years to 5 years, this is going to go up tremendously. I started this challenge to try to make it as simple as possible for like an everyday person, someone that can just invest a certain amount every week. You pick a stock that you like. You have to do a little bit of research, right? But I've looked around, I've done some research, and I found a few stocks that I want to invest in. As you can see, I am now currently I'm consolidating. I don't want to be too diversified. So I sold Adobe and I sold Google. Reason is, I believe MU is going to be a bigger play. HIMS and Celsius, I believe, are going to be bigger growth than Adobe. I'm also in ServiceNow and Salesforce, which I think, as my SaaS companies, I don't want to have too many. And Adobe, as much as I use it, I'm going to use it to edit some of this video. I use it at work, at Fox Sports. I just don't know if the stock and business is going to grow as fast as these other businesses. So because of that, I sold my Adobe and I'm out. I'm going to put that money into Celsius, HIMS, Micron, Salesforce, and ServiceNow. Those are going to be my main buys. And I'm going to continue to buy those. And that's what I want to do. I don't want to diversify too much. I want to make it as simple as for somebody who is working, has, kids, all this stuff, that they can take a little bit of time, do a little bit of research, find some good quality companies, a few of them, and just continue to invest in those few companies. I don't want to spread myself out too much. Buy some Google, buy some Adobe, buy some of this, and buy some of that. Find some really good, strong companies, good income statements, good stocks, or maybe it's a bad stock. Maybe the stock isn't doing so well, but the company is doing well, and I know the stock will do better in the long term. And all I got to do is stay patient, continue to buy low, and then sell high later if I need to, right? So that's what I'm doing right now. So I sold Adobe. I sold all my shares for $521. Then I bought some Celsius, bought HIMS, Micron, and I sold the remaining of Google, which again, my Google was only $57. It's not like my Google position was big. So that's another reason why you could say, well, it was just a small position. Having another name in there to look at and just think about, I didn't want that right now. I want to focus on these few. Again, this challenge, I do focus and I research and I'm involved in all these companies in the sense of knowing what they're doing and all that. But in terms of this challenge, I want it, like I said, to be for people that don't have a lot of time to go through as much. Because even though I do have a full-time job, I have my 2 kids, I have a lot going on in my life. My job at times allows me to spend time to do this. There are times where the production is off early and I'm able to spend extra time rather than a 10-hour, 12-hour construction worker or someone who's working. There's a lot of people out there that have to hustle a lot more than working 2 jobs. This is my second job. To try to give out as much information and stuff. And I know people do not have that luxury. And I would say there's times where, maybe I'm like, hey, I need not exactly get another job. I need to find a way to make more money. But I believe in the long term of what I'm doing here. I believe that if I continue to put out really good information, that I will have people continuing to watch and return to my channel, I can eventually start making some money off this. That is my goal, is to make money off my YouTube channel and investing, so I don't have to depend so much on an outside company like Fox Sports, even though I believe sports media is going to be just completely fine and my job status there is totally fine. I'd rather make money from home. I'd rather make money from Hawaii if I could. Right? And the thing is, this is one thing I truly believe, and I've noticed, it doesn't matter who you are. I've seen people not know anything about the stock market. They don't care about the stock market. They never really did anything about this. Then they retired, and the stock market mattered. I want to be, because when you retire, all of a sudden, the stock market is going to be dealing with your money so much, right? A lot of the times, unless you have it in just like an index fund, but even at that's a stock. If you have it in just treasuries, or you just have it in like a savings account, which would be ridiculous, a lot of people, most people have their money tied up in the stock market. So I was also thinking, well, I will retire one day. And when I do, I want to be as educated and experienced as possible to dominate my retirement. When I retire, I don't know. I don't know if I'm going to retire next year. No, probably not. But never know. Maybe that one day I hit that lottery. I could retire in 5 years, 10 years. I'm 37, so I guess technically 25 years, 62, right? But the point is, I do not want to be left behind at that age. And I've seen those people who did not pay attention as much at all. And I'm like, man, you could have done so much more. Now, granted, when you're older, you want to take less risk. But when you're older, if you don't know what risk is, if you don't know how to value risk or assess risk, then you'll lose money. A lot of people will go with a financial advisor and kind of do all this and that. That's mostly what they do, right? I'm going to tell you, if you can figure it out yourself and do it yourself like this, where I'm actually making the buys and sells, you'll be able to make more money. So that's why I'm doing everything that I'm doing, so that I can be better. But I don't want to diversify too much. I'm going to consolidate into some high growth companies that I think are just going to expand this portfolio a lot, because this is a retirement. This is a retirement account. I have other accounts, but this is a retirement account. This is a long-term play that I'm going to be putting out there for as long as I can. So currently, this is my current portfolio. I probably should have put this up earlier, but said it before my rant. But this is my 100K challenge, $9,226, mostly TQQQ, which is a 3x index for the NASDAQ. It's done very well for me over time. I should have bought when it went down in the 40s. I really should have added to my position. It's just such a big weighted position of my portfolio. I know Hims and Celsius will catch up eventually, but it does play such a heavy current spot in my portfolio, and I do know it eventually will crash again at some point, because it is 3x when the NASDAQ, if it crashes 10%, which it will at some point, of course, the TQQ is going to go down 30. Okay, so I understand that it is a high risk, but it's clearly been high reward. I've held on to it for a while, and I plan on holding on to TQQQ forever. It's going to be a forever stock. If anything, I'm just going to buy when it goes down, because the stock market eventually is just going to go up. Do I believe in the next year what's going to happen in the stock market? I don't know. In the next 10 to 20 years, I know where the stock market's going. It's going up. So TQQQ, 25% of my portfolio. Then I have Hims and Celsius, rounding off at 18 and 16%, almost equal. Meta, Amazon, Salesforce, MU, ServiceNow, and then Oddity, which I'm actually probably going to sell when they release their earnings on June 2nd. I'm waiting for it to pop. It is one of my only real big losers, Celsius. I'm down 14% because I bought at 35. I have another account where I bought at 25. But this one I bought a little bit later. So I've been actually averaging down. I've been averaging down. So I have added to my Celsius position. But other than that, really, it's oddity that went down a lot. And when you look at how much money I actually lost, it's not too much. This isn't to say I haven't lost money on stocks. Fubo, I was down about 60%, maybe 50%. I lost money on that. And then next week when I do my yearly review, I'm going to go over all the gains and loss that I did from all the transactions. Again, I want to take full accountability, full transparency of what I do in this. And I may not be an absolute guru, but what I'm trying to do is, again, something that a common person can do. I don't want to deal with options. I don't want to deal with constant trading, right? I want to find stocks that are good, put money into them, and just have a consistent deposit. I do rebalance here and there, right? Like I sold my Google, I'm selling my Adobe because I realized I was starting to buy too many. And I know for just a regular person who has just a little bit of time to put into this, they're not going to be able to do that. So therefore, I just want to consolidate more, buy the same consistent amount per week, but just be dealing with less companies, because people don't want to have 15 companies to have their mind wrapped around, right, when you're dealing with life. So this is my portfolio. I still have $415 in cash that I do want to deploy here soon. It's actually going to go up because my deposit's going on Monday. So I'm going to have about $465. And yeah, so I'm going to be deploying that money probably some more into Celsius. I probably will. I mean, when you look at the total change, I'm actually in Celsius more. The money that I have invested into Celsius is more because I'm down 14%. And when you look at it, it's just slightly under HIMS, right? It's only 1.5% less weight, but it's about 21% difference in performance. So I do have a lot invested into Celsius. I like these prices. I like this cost base right here. For HIMS is 22, Celsius is 35. I like those. MU, I invested like $50 or something like that, and it was at 400. I wish I'd put more into MU. And that's when it was like I was looking into too many things, going into too much, and I really should have just focused and said, hey, this is what I really truly believe. And I saw MU's numbers, and it almost seemed too good to be true. And that's why I think I initially didn't do it, or didn't put more. I was proven wrong, and for right now, I think, going to consistently buy some MU. For right now, it's going to be my hardware play. So thank you for watching. Please give a like and subscribe. I appreciate it. The algorithm appreciates it. I do put in a lot of time. Like I got work in 45 minutes, and I spent an hour and a half before just doing all of this stuff. I was actually doing it last night up to like 1 a.m. So, I really appreciate the likes and subscribes. They help so much. So if you can, I do appreciate it. And anyone who is watching still right now, if you're watching right now, you are already, even if you didn't like and subscribe, you help tremendously. When you watch most of my video, I really appreciate it. So yeah, everyone who does like and subscribe, I appreciate it. Even if you don't, if you're watching, I appreciate it. I appreciate everyone as long as you're not, I guess, a bad person out there, right? So anyways, thanks for watching, and never forget to earn it, save it, invest it, buy low, sell high. I want assets, not liabilities, and you can count on compounded interest.